Welcome back to this special Indianomics on investment trusts. We have been speaking with Shilpa Kumar, the Managing Director of ICICI Securities, R Shankaraman, the Head of Finance at Larsen & Toubro, and Neeraj Gambhir, Managing Director and Head of Fixed Income at Nomura. Well, Neeraj, therefore, should we assume that we will not get stable revenues? What should the investor be prepared for? Will he definitely get at least above GSEC revenues? Is that a given?
Well, certainly, I think you are taking a project risk in, especially if the underlying is roads. You're taking quite a bit of project risk, and therefore the investor expectations of returns are going to be considerably higher, is my opinion. There will be certainly some, variability depending upon the composition of the underlying assets. What is the composition of annuity versus toll? If it's entirely annuity, then certainly there is a lot more stability. But if there is a combination of, toll versus an annuity, then there is a lot more variability. So, like it was said before, you need to look at the composition of the underlying assets. What is the stability of cash flows of those assets? And apply some kind of risk assessment, some kind of stress analysis, and then come up with a certain amount of return that you need to have to justify investing in that project. Now, to some extent, people are used to doing all this. I mean, when banks, for example, take credit risk on a road project, they do that analysis, they do that variability analysis to see what kind of volatility can be there in terms of underlying cash flows. So again, you can't put a number, you can't say 200 basis points over G6 is sufficient. I think the project composition will decide what is the desired return. If it's a very high variability, then maybe the returns need to go up to, say, double digits to justify taking risk in that asset.
Yeah, but this will be more like closed-ended, isn't it? Unlike REIT, which may continue, for a longer period, an investment trust can last only as long as the concession period for that project lasts. So, does it work like a fixed maturity or a longer term, maybe a closed-ended fund kind of product, Neeraj?
You do have investment trusts where the trust manager has the ability to sort of take on new assets as and when they become available, right? So again, the design of the investment trust is very important.
So you mean this?
If it's a design in which you are saying that just a fixed number of projects and that's it, so those will work like a close-ended or rather defined maturity. So if you have trusts where you have the optionality available to the investment manager, where he can actually take on fresh assets, then it could be a little bit more like long-dated, open-ended sort of investment trust. But design is very important in that sense.
Okay, so the sponsor can continue to add new assets. In that case, is there any quality control? Because if it's privately placed investment trust, I can imagine that there will be 20 people who will be able to take a call on whether he's bringing quality trusts.
Right.
But when it is some thousands of not thousands, maybe say 100 investors in an INVIT, how will you take permission, Shilpa? How will a sponsor take permission?
So I think, INVITs have taken some time to kind of get going, and partly that's because the regulators spent a lot of time thinking through all these, future potential issues. And, this whole move towards majority of minority, those kind of governance structures are really intended to kind of keep, good governance in trusts like this, and to make sure that the voice of, the investors is heard. And it's not like they're passive investors and really the operator kind of can do whatever he wants. So I think, regulation has kind of looked at all of these future eventualities, put some thinking into the governance process, and that's why I think it's got.
So there will be a voting?
Yes, correct. So at the trust level, the investors will have a right to take a view on whatever is going to happen.
So if one concession ends and another new road is getting added, then it happens through vote?
Yes, that is correct.
Okay. Mr. Shankaraman, look at the state of infrastructure companies today. Many of them have not been able to service their debt with the kind of money they are getting, and capital returns on their capital is fairly far out for a large part of the infrastructure projects that are currently in operation. won't that be a risk? Is there a meeting ground at all between what the infrastructure builder wants in terms of returns and what investors will be able to pay?
See, in our conversations with investors, what becomes clear is that they are not only looking for return on investment, they are also looking for return of investment. So the approach that they take is, let us take a project takes about 3 years for the construction to get completed and the project get commissioned. And let us take another 3 years for the traffic to stabilize, for people to have some visibility of what the cash flows would be. That virtually in today's era leaves a period of about 15 years for the investors to take a call on the project. Within this 15 years, he needs to get return on investment as well as return of investments. So he is possibly looking at maybe about 10, 11, 12% of cash yield, which represents both the principal return and the interest return. Now the investors were more energetic and more enthused about these projects today, unfortunately, happens to be international investors, and they have to take care of the currency aspect as well. So considering all of this, we find that for this product to fly, it is very important that the underlying cash flows are made attractive. And this is where this government needs to come in. It is not so much of a financial concession. They have to address the point that the investors who are private are beginning to hold public assets. When private capital owns public assets, there is a lot more responsibility than just concessions being given. Now, let me take a case in point. You touched on this demonetization aspect. We do understand the importance of this measure and are supportive of it. But at the same time, the economic consequences of these measures need to be fully understood. If collectively, all the toll road companies have lost about 1,500 to 1,800 crores during the period of 1 month holiday that they took. The understanding was that cash will be replaced by whatever benefit that would come from the government. Debts have to be serviced. The toll operations have to go on, so there are cash obligations available. When cash flow stops and that are not replaced by like-to-like cash flows, then there is considerable damage that gets done to the debt servicing capability of the toll operator. Today the government is thinking about extending concessions to be able to compensate. Now, cash losses cannot be compensated by back-ended concession extensions. Now, these are very fundamental economic principles which actually enthuses an investor to look at these assets with a lot of interest and predictability. Today, the bane seems to be that these assets are viewed as higher risk than what they intrinsically are. And I think the policymakers and the operators need to make sure that the risks are minimized and well articulated. We are, I think, some distance away from doing this, and which is why I feel while the regulators are ready, the bankers are ready, the product is possibly ready, the investors are still shy and they are looking over the fence to see how they can get predictability to the revenue flows.
I agree with you on the political risk. Sometimes market disciplines actors, and it is possible that when there are, say, a dozen investment trusts, the government also will realize that it cannot play fast and loose with returns. But Neeraj, I still want to come back to whether there is a meeting place for sponsors and investors right now, today, when infrastructure has borrowed so heavily and growth has come short.
So I think that's where the track record of the projects will be very important. The corporate governance standard of the sponsor is extremely important. I think the overall corporate governance that they have displayed in the entire suite of whatever investments that they have made is going to be extremely important. So while we look at the cash flows, we look at the variability of cash flows, the underlying projects, the economic aspects of it, these are all important things that will go into it. I think equally important will be the softer aspects like, what is the corporate governance arrangement that is there with respect to the, investment manager? What are the historical track record around, managing these issues? So that's extremely important from investor standpoint. I think in the beginning, I would say that, you would see probably more success around fairly well-established sponsors who have a track record in these asset classes. Those are the kind of players who will be able to attract quality investors. Those are the guys who will be able to sort of get the INVITs priced tightly. I think that's something which we will see probably.
Okay. Well, Shilpa, we have to wind up. So something which the viewer can take home. What are likely to be the initial returns? Will INVITs be priced around 10%?
Yeah, so I'll say around 10 is a kind of good way to put it because, like I said earlier, if there are assets which are more fixed annuity in nature, you might see it even a little bit below that. But if there are assets which are a little bit more variable and there's a possibility of upside, you might see something above that. And everything we discussed on the show, all of that goes into determining exactly where around that number.
But considering that, airports have been stalled or become more expensive than they were originally intended, ditto with roads, are there enough investor sponsors to bite at 10%? Will they want more?
No, so it's all a question of, what's the annuity looking like, what's the variability implied in those cash flows, and what's the, so to say, the sponsor's intent. So if actually you are, a sponsor who can free up capital and actually go out and invest in more assets, then, you might be willing to, in the interest of getting the market started, you might be willing to leave something for the investors, and that's always how the process works.
Shankaraman, Neeraj and Shilpa, thank you very much for putting some initial thoughts on the table. This is the first of a series of discussions I'm sure the media will have on investment trusts. But if Shilpa is to go by, we are going to see it sooner rather than later. Thank you very much for watching this edition of India Topics.